September 16th, 1992, London, England. Inside the Bank of England, officials raise interest rates twice in a single day, trying to save the pound. By the end of the day, they will fail, and one hedge fund manager on the other side of the trade will walk away roughly $1 billion richer. The pressure had been building for 2 years. In October 1990, Britain had joined a European currency system called the Exchange Rate Mechanism, a decision championed by then-Chancellor John Major, and, more reluctantly, agreed to by Prime Minister Margaret Thatcher in the final months of her time in office. This system required Britain to keep the value of the pound within a narrow band against other European currencies, anchored mainly to the German mark, part of a broader push toward monetary coordination that would eventually lead to the euro. The idea was to create currency stability across Europe as a step toward closer economic union. The problem was the rate Britain joined at. Many economists believed the pound had been locked in at a value that was simply too high, more a political decision reflecting national pride than a careful economic calculation. 2 years later, the mismatch had become impossible to ignore. Germany, dealing with the enormous cost of reunifying with the former East Germany, kept its own interest rates high to control inflation. To keep the pound pegged to the mark, Britain had to match those high rates too, even though the British economy was in recession and desperately needed lower rates to recover. Keeping the peg meant choking off Britain's own economy to support a currency system built around Germany's very different problems. A Hungarian-American hedge fund manager named George Soros, along with his lead trader Stanley Druckenmiller, looked at this setup and saw an opportunity that seemed almost too obvious. Soros himself had an extraordinary personal history behind the calm exterior of a billionaire investor. Born in Budapest, he had survived the Nazi occupation of Hungary as a Jewish teenager using false papers, then fled the country again in his 20s after the communist takeover, eventually rebuilding his life and fortune in London and New York. By 1992, he ran one of the most successful hedge funds in the world, known for making large, concentrated bets on major economic shifts rather than diversified, cautious positions. Through their fund, Quantum Fund, Soros and Druckenmiller concluded that the pound could not realistically stay inside the currency band. Britain's economy was too weak, its interest rates too painful to sustain, and the political will to keep defending an overvalued currency looked fragile. According to later accounts, Druckenmiller initially proposed a large but relatively cautious bet against the pound, and Soros pushed him to go much bigger, arguing that a mispricing this obvious and this large came along only rarely and deserved to be bet on with real conviction rather than caution. Through the summer of 1992, Quantum Fund quietly built a massive bet against the pound, essentially borrowing British currency and selling it for other currencies, planning to buy it back later at a much lower price once the pound fell. By September, the position had grown to roughly $10 billion, an enormous, highly leveraged wager that the British government would eventually be forced to let the pound fall. Even before that day, the Bank of England had already been quietly buying pounds for weeks, using its reserves, hoping to convince markets the currency would hold, without ever having to make a dramatic public show of force. By the second week of September, rumors were circulating openly among traders in London and New York that several major funds, Soros's among them, held enormous short positions against the pound, and confidence in the peg was eroding fast enough that even routine currency trading desks were watching the pound's price minute by minute. Other traders, sensing the same weakness, piled into similar bets against the pound, and pressure intensified through early September. The mechanics were straightforward in principle, even if the scale was extraordinary. Quantum Fund and others borrowed pounds from banks, immediately sold those borrowed pounds for German marks and other stronger currencies, and simply waited. If the pound fell as they expected, they could later buy back the same number of pounds for far fewer marks than they had originally received, repay the loan, and pocket the difference as pure profit. The bigger the eventual fall, the bigger the payoff. The Bank of England spent billions of pounds from its foreign currency reserves buying pounds on the open market, trying to prop up the price and prove to speculators that the currency would hold. It did not work. Money kept flowing out of the pound faster than the bank could buy it back. And by some estimates, the bank ultimately deployed close to £27 billion in reserves over the following days, trying to defend a currency that was already effectively lost. On the morning of September 16th, with the pound sliding toward the bottom of its permitted band, the Bank of England raised interest rates from 10 to 12%, hoping higher returns would tempt investors to hold pounds rather than sell them. Traders barely reacted, and the selling continued through the morning almost without pause. By early afternoon, the bank announced a second increase to 15%, an extraordinary jump meant to signal absolute, unshakable commitment to defending the currency. Markets were unconvinced. Traders correctly judged that a government desperate enough to promise 15% interest rates in a single afternoon, a level that would have been painful for homeowners and businesses across the country, was a government about to lose the fight, not win it. And the selling only accelerated. By early evening, officials admitted defeat. In a now famous press conference held outside the Treasury on Downing Street, Chancellor of the Exchequer, Norman Lamont, announced that Britain would suspend its membership in the exchange rate mechanism, allowing the pound to float freely, rather than continue spending reserves defending an unsustainable peg. Photographers captured his visibly grim expression as he read the statement, an image that ran in newspapers across the country the next morning. The interest rate hike to 15% was quietly reversed the very next day, never having taken effect in any meaningful sense beyond the announcement itself, a detail that only deepened the sense of chaos and improvisation inside the government that day. Estimates of the total cost to British taxpayers from the day's failed defense ran into billions of pounds, with some assessments putting the direct loss around £3.3 billion, once the bank's trading losses and the cost of the aborted rate hikes were accounted for. For Soros and Quantum Fund, the outcome was the opposite. Once the pound was allowed to float, it fell sharply against the mark and other European currencies within days, losing something on the order of 15 to 20% of its value. Quantum Fund closed out its position at the new, much lower price, turning its multi-billion-dollar bet into an estimated profit of roughly $1 billion in a single trade, one of the largest and fastest currency profits ever recorded by an individual fund. Soros was not alone in profiting. Other prominent investors, including Julian Robertson's Tiger Management and commodities trader Bruce Kovner, held similar bets against the pound and walked away with substantial gains of their own, though none matched the scale or the eventual notoriety of Soros's position. British newspapers, looking for someone to blame for the humiliation, settled on a nickname for Soros that stuck for the rest of his career: the man who broke the Bank of England. The political fallout in Britain was severe and long-lasting. The governing Conservative Party's reputation for competent economic management, a core part of its political identity going back decades, was badly damaged in a single afternoon. Norman Lamont remained in his post for several more months, but faced relentless criticism in Parliament and the press, and was eventually replaced as Chancellor in 1993. Political historians later pointed to Black Wednesday as a turning point that permanently weakened public trust in the Conservative government, one of several factors that contributed to its landslide election defeat 5 years later in 1997. The day became known in Britain simply as Black Wednesday, a shorthand for national economic embarrassment that persisted in political memory for decades afterward. The irony, acknowledged by economists in the years that followed, was that leaving the exchange rate mechanism turned out to be good for the British economy in the long run. Freed from the obligation to defend an overvalued currency with painfully high interest rates, the Bank of England was able to cut rates sharply within weeks, from that brief, never-implemented peak of 15%, down toward more manageable single digits within about a year. Growth picked up steadily through the mid-1990s, inflation stayed low, unemployment gradually fell, and Britain entered one of its longest sustained periods of economic expansion in decades. Some economists later suggested the day should have been remembered as White Wednesday instead, at least from a strictly economic point of view, even if it never felt that way to the politicians who lived through the public humiliation of the moment. George Soros went on to become one of the most famous, and to some, most controversial financiers in the world, using the fortune built partly on that single trade to fund a global network of philanthropic and political causes through his Open Society foundations, work that made him both widely admired and, in later decades, a frequent target of criticism and conspiracy theories from political opponents around the world. Stanley Druckenmiller, the trader who had actually built and executed much of the position, went on to run his own fund, Duquesne Capital, for another 2 decades, becoming legendary in his own right among professional investors, even though it was Soros's name that ended up on the newspaper headlines. Within the finance industry, the trade became something close to legend, taught for years afterward in business schools, and referenced constantly by traders as the clearest possible example of a fund correctly identifying a government defending an indefensible price and betting everything on the certainty that reality would eventually win. He made about $1 billion before dinner.